Hello Propenomix people, and welcome to the supplement from the 1st of October 2023 as quarter 4 begins. So as you know, I like to always start off with a quote, and this week's is, if you're going to be a great investor, you have to fit the style to who you are. And that's from Dr Michael Burry, the American investor and hedge fund manager. So, you know it must be a bearish week when I reach for a Michael Burry quote. For those who haven't seen The Big Short, it is a must-watch. Burry, played by Christian Bale, is an unbelievable character. There's so much learning in this film. I honestly can't recommend it enough, and I rarely even consider watching a film, let alone re-watching one. But in the past 10 years, I've seen it at least 10 times. And just writing or talking about it makes me want to watch it again. Burry had taken a large short position against the S&P stock market in quarter 2 this year that was revealed by his mandatory SEC filings. The news of this broke in August, shortly after the deadline for the Q2 filings. We don't get to follow this in real time, although you can always take a look at the Twitter or X account @BurryTracker for more news. I also recommend @BuffettTracker, even though there really should be 3 T's in the middle of that, there's only 2. Dr. Burry also sometimes shares some pearls through his own Twitter or X account, if Twitter is your thing. Why the shout out to the master of shorting? Well, because there do seem to be some parallels with the 2008 scenario, in a way. Dramatic changes to the price of credit rather than the availability of it, over a much, much longer time frame than 2008, but nonetheless likely to have a similar but more muted effect. If you factor in inflation, and believe the most bearish of the indices out there, which are the Halifax and Nationwide, then you could argue this has already happened. That isn't the main thrust for me today, though. I'm more interested in what has happened versus what probably should have happened, or arguably what we're all glad hasn't happened, and that's why we're entrenched with property rather than crypto or stock trading, although I know more than a few supplement listeners will have or still do dabble or take a keen interest in either or both. Before we get to that, however, I just wanted to do the macro roundup. Firstly, the calm in the bond markets hit a rocky patch this week as gilt and swap rates surged midweek after the conclusion that oil prices are not getting to where they should be because the expectation is that inflation means that interest rates will remain higher for longer in developed nations. The 5-year gilt was trading happily in a tight range between 4.1 and 4.2% until Wednesday afternoon when it broke out to reach 4.4% on Thursday at some point, a fairly significant move in one day. In plain English, that's worth 0.25% on the mortgage rates. More accurately though, it's 0.25% that's not come off rather than gone on. The lenders have been slow to come down from the highs, which were more like nearly 5% on the 5-year gilts, and so can still be a bit trimmer than they were a month ago. But these unsettling days where things move more than 0.25% don't go down well. I know it doesn't sound like a lot, but we're talking markets where many, many millions are traded daily in what's supposed to be ultra low risk assets. Some better looking deals did start to rear their head this week, but product heads might well wait and see for next week before getting back to the table. UK car production was down nearly 10% year on year, which was a surprise as the expectation was positive growth. However, 12 months ago the number was up 31.6%, although as always beware the base year effects. The pandemic would definitely have made a difference to that figure. Friday contained the most interesting macro stats this week, including finalised, although they're never really finalised, growth figures for Q2 2023. The mortgage and credit figures were also out for August and they made interesting reading. GDP growth rates for Q2 were ahead of expectations, and it turned out to be a pretty good quarter by today's standards as inflation ebbed away a little. Sad to say, but 0.6% annualised growth is the best we've seen for some time. Remember that's in real terms, so ahead of inflation, not to be sniffed at in the face of the interest rate rises. The forecast was 0.4%, so it was an outperformance compared to that. Mortgage lending was also about £1 billion more than expected, and there was a net mortgage balance increase of around 1.25 billion last quarter. Nothing in the grand scheme of things, but the expectation was no real increase in balances. So again, a positive move, as expanding credit means a more expansive market as a whole. Consumer credit was also about 1/3 of a billion more than expected. The consensus is starting to be that pandemic savings have run out and people borrowed a little more to enjoy their first truly COVID-free summer in terms of restrictions. Although after the recent spate, masks have started to appear again, of course. But overall, this was the first set of data for a while that suggests the economy isn't on life support, but has been doing okay against the odds and against some of the incompetence that has plagued the last 18 months, particularly before the current iteration of Prime Minister and Chancellor were at the helm. So back to Burry. What feels like the most pertinent part of economic history and the film is the way that he spotted things early, very early. In March 2007, when the financial world was still going great guns, as was the property market, he was starting to build significant short positions against what he'd identified as the impending mortgage price crash. He first mentioned post-pandemic inflation in April 2020, which was obviously a fantastic call, and earlier than anywhere else I'm aware of. I didn't see that at the time, sadly. If you could criticise the great man, it would be that he sees the angle, but doesn't necessarily see the timing of the angle. That's incredibly difficult, of course. As the great Uncle Warren would say, time in the market, not timing the market. Burry has proved to be a fantastic directional predictor, but struggled with the timing of it. He isn't right every time either, of course. He's obviously very good at what he does, having traded his way to billionaire status. He annoyed and ostracised many with his singularity leading up to the 2008 crash, and his dramatised character is seen bemoaning just how the big banks and investment houses manage to keep the music going when the writing is on the wall, for just long enough to unload or reverse the massive positions that most had taken in the subprime mortgage markets onto unsuspecting punters. This is where I'm most interested at the moment. Of course, if you say the stock market is going to come off the top at some point in the next few years, in many instances you'd be right. So that isn't that helpful. However, to go around buying put options, which are the right to sell shares at a price even if that price has collapsed, you wouldn't want to exercise those options if the prices had risen, because that would be a losing trade. But you need to be confident that you're going in at a level that is overvalued, and your options have an expiry date on them, of course. If they expire, and Burry has tended to use relatively short expiry dates in the past on similar trades, then you need to buy them again until you get it right. This week the market hit a 3-month low, although perhaps not enough to make a profit. It seems though from his recent breadcrumbs clues that he tends to leave, that he is expecting a significant downturn. He tweeted, back when it was still Twitter, in January, one simple word: sell. Let's also remember, he's a professional short seller, a bubble spotter. All of his form is in seeing the angle when stocks are priced too high, in an unsustainable way. He's only ever going to do two things. Number one, stay silent, which he does the vast majority of the time. Or number two, act or speak when he expects negative things to happen. The implication, although interviews with him are as rare as hen's teeth, is that he feels the economy can't cope with the current level of interest rates. He's talking, of course, about the US, a much stronger and larger economy than the UK, but one with a base of interest at 5.25% at the moment. Very familiar. The Fed have been within 1% of that rate for 12 months now, however. The UK are a fair way behind, as only the hapless trust forced a 0.75% rise out of the Bank of England, whereas the Fed scattered them around like confetti at the start of this hiking cycle, showing they mean business from day one. We have to go back to before this current cycle kicked off. I personally definitely did not have the clarity of thought when it came to how speedy the hikes might be, thinking back to early 2022. Ukraine also took me somewhat by surprise, until we were only a few weeks away from the conflict. I was in line with a lot of other economic commentators, not around inflation, where I was very vocal that it was happening, but around whether the economy could withstand a significant hike in interest rates. What we're hearing left, right and centre, in the data rather than the speculation, is that rates haven't had the effect they usually would. For all the furore over the mortgage crisis, the average homeowner with a mortgage, 28% of UK households, is seeing a rise of about £250 a month. That's £250 out of disposable income. Sure, but disposable income is also up over £100 a month, assuming a 5% pay rise after PAYE rates of tax in this year, which at least partially mitigates that, based on an average owner-occupier with mortgage household. Doesn't help those households increase their consumption spend though, of course. They have to cut down or borrow. Much more sensitive are the 2 million encumbered buy-to-let properties, which data suggests include about 1 million on old floating rate mortgages. Those are much more at risk since they are interest only, likely to have increased by a similar amount, but given much higher costs of maintenance, insurance and also the Section 24 tax that the majority of those landlords will be paying, that puts much more pressure on the rent of households, which have a much lower average income than the average owner-occupier with mortgage. So you might be talking more like £300 a month, but a £75 per month pay rise after tax. Much harder to deal with. Those figures are only my own, as no quality data exists to this level, sadly, or none that I'm aware of anyway. We know that a lot of corporations fixed debt in early 2022, when their well-remunerated financial controllers saw the writing on the wall and went for some very long-term debt. The average bond issue was for 17 years in the big companies, compared to only 10 years in 2023's issues. This is all fine, but still many listed companies have bond issues dropping off next year and have a difficult decision to make on the debt. Pay a coupon approximately 2.5 times larger, or pay off the debt with retained earnings if they have it, or raise it via equity, of course, which will affect the share price and earnings per share negatively. This isn't really the strangler though. If you followed what I was belting out last year, you likely had a very good think about fixing your mortgages for 5+ years, or at least had a look and stress tested your position and decided to ride the lightning. The strangler is new business, new starts, adding to the portfolio. The obstacles are significant if you want to use leverage. The numbers don't work like they used to. That's all fine, but if you think about the way the market works organically, if everything else remains equal, older, probably unencumbered landlords pass away or sell up, with only a fraction handing their portfolios down through the generations. New, younger landlords, much more likely to be using leverage, work out where and how to deploy their money. Returns on government bonds, or for those less likely to invest in bonds generally, in 1 to 5 year savings accounts, look more attractive. Investing at under the rate of inflation is not to be recommended, and inflation remains the biggest danger to wealth once you have some. But inflation shouldn't run at the 5% or so that's on offer for some investments right now. Although remember the tax. If you're a 40% plus payer, you're taking a 3% return, which might well be below inflation's average for the next 5 years. Regardless, 5% compared to 0.5% in early 2021, or even less than that, is where we've got to. Investment gets deferred elsewhere rather than property. Supply and demand, already under gigantic pressure since the Osborne onslaught started a tidal wave back in 2015, was already in a very precarious position, and I've just laid out how it's even less attractive today, just thanks to the price of credit and stacking deals, than it has been for years. In 2019 it was a great year, a flat market, cheap money, easy enough to get deals. In late 2020 and until mid-2022 it was difficult. Market flooded with lots of extra money, even cheaper interest rates, and a lack of supply combined with huge demand. But if you bought well during that period and fixed rates, then happy days. Mid-2022 onwards, trappier. Mortgage rates moving upwards and then surging intra-truss. Blink and you missed it. Q1 23 looked like rates coming right back down, but it was too early, and instead yields went to the points they were in 2022, or beyond, depending on the duration. Another tough year for bonds. So, it feels like something is still off. I'm left asking myself, what am I missing? There's all the ingredients for ongoing rent rises until tenants are crying, and until more and more are forced into social or supported living. Affordability ceilings are a way away, but at nearly 25% rent increases on new lets in the past 2 years, and forecasts around 7% for the next 12 months, it won't take long in property terms to get there, depending on wage increases, of course. Supply and demand is so bad that it has a very limited effect anymore, Affordability seems to be the chief defining factor by some way. What else could be wrong? I think on balance it's this tapestry of stable rates being predicted that I'm struggling to swallow. I do think rates have to remain high until inflation is conquered, and that's why I was on the side of an increase last week. The wobble in the gilt markets midweek was all based around the market believing that a little more than they did before. Stability just feels so unlikely when we're now on an interest rate tightrope, higher than anyone would have dared predict 2 years ago. If we went into recession in any significant way, rates would surely, at the start, still have to stay high. It would be the lesser of the evils. Then after demand had truly collapsed, inflation would wane and rates could be cut. Go back in history though and look at recessions where inflation has been high on the way in. The cuts aren't as swift as some might like, and for good reason. And in proportional terms, this is the most swift hiking cycle by a million miles. That's what's making me feel uneasy, and also unsatisfied because I don't feel I have an awesome handle on it all. I want to know all the answers and then share them in the supplement, of course. There is another side to this coin. Keeping rates low for so many years in the 2010s showed a serious lack of ambition or willingness to experiment, or even political influence perhaps. I was a big Mark Carney fan, but there's definitely questions to be answered as to why we hadn't even tried to get rates up in 2015, when the forward guidance had said we would, once employment went under 6%, for example. And yes, they still would have had to come right back down in 2016 after the referendum. Brexit provided the perfect excuse for further inaction, though. The Fed tried in the US to get rates up, but they had limited resolve and gave up too early on in 2018. The markets at that point thought they could pretty much control the Fed, but in this cycle they underestimated inflation and what inflation would do. The central banks have at least tried to do their job with a degree of competency, and it's easy to criticise when you already know the answer. Looking back, my calls have not always been perfect, although a couple of the big ones have been right over the past few years. Not getting it wrong is critical on the big calls. Either way, I'll continue the quest for the truth, or at least a coherent set of arguments, as we continue into the last quarter of the year, and that brings us to a close for this week. I'd love to get some comments and feedback, of course, as always. Please make sure you tune into the 9 a.m. live on this YouTube channel if you can, or watch on repeat. If you don't already know about it, just make sure you look at the videos on the channel. Thanks for tuning in, and I'd very much appreciate if you could like this video and also subscribe to the channel. And of course, it only remains for me to say, keep calm and carry on.